what is not quant investing. It is not a black box, some set of code that just picks a few stocks and runs throughout. It's just a set of rules. We don't make decisions based on our mood or emotions. So in our office, we won't be watching CNBC TV or looking at news channels to decide what's happening today.
Free from all human bias.
Ultimately, if a company reports earnings, then the stock will move. If there are no earnings, the stock will not move, right? In the next 5 years, I think what's going to happen is that there is going to be a shift of power. When will that shift of power happen? When that happens, there will be volatility, which means there will be a lot of opportunities.
India's market story in 2026 is not just about chasing narratives. Now the focus is on decoding the numbers. When volatility tests, conviction and valuations gradually adjust in front of earnings, then one big question arises. Can data make a fund manager more powerful than emotion? And today, in this episode of Market Pillars Uncovered, we are going to explore this very question. Today we have with us Mr. Rishabh Nahar, partner and fund manager at Qode Advisors LLP, has more than 8 years of experience. He specializes in equity and quantitative research, and Rishabh is a self-taught coder. He combines financial insight with algorithmic processing. The focus is on building systematic models that decode market behavior instead of chasing it. In 2016, it was among the early pioneers of code in India, in the quant investing space when data-driven strategies were still at an emerging stage. Today, as a SEBI-registered PMS firm managing 300+ crore AUM, it represents evidence-based investing. In today's conversation, we will talk about system-driven investing versus discretionary investing and the changing landscape of investing with technology and AI. On code investment strategies, the road ahead for the Indian economy, and those high-growth industries where data is giving strong signals for the future. Let's get started. Welcome to Money TV, Rishabh. Thank you so much for joining us today for this conversation.
Thanks for having me.
So first, let's talk about 30 new concepts of investing beyond the traditional style. If we look at quant data-driven investing, about all of these things, there's a lot of discussion happening these days. So exactly what is this stream of investing and how is it different from the traditional form?
So I think so. First of all, this is also a new concept in India. If we look at it globally, quant investing has been around for more, 20, 25 or 30 years basically. Ever since the advent of data, ever since computers arrived, the guys who were early in the game, they started investing using data right from the beginning. They have done really well, but now because it's become more common, so now I am hearing more. I think quant investing became famous in India when the Quant mutual fund was started by Mr. Sandeep Tandon. So he was one of the first. He himself has been doing this since 2006 to 2007. I would say that in terms of quant investing, whenever I talk to any investor or audience, I like to break down, but to get the concept very clear, we break everything down to first principles. First, understand what quant investing is not. It is not a black box. It is not a set code that will simply throw out some stocks. It is just a set of rules. So quant is just a set of rules. When we combine that with investing, what we are trying to say is we will use a disciplined approach where we remove subjectivity and do not make decisions based on our emotions. For example, in our office, we are not watching CNBC TV or any news channels to decide what is happening today and then take investment decisions.
Free from all human bias?
Absolutely free from all human bias. A very simple example of a quant model is the Nifty 50. If you look at the Nifty 50, those 50 stocks, do you know how they are included in the Nifty? It's based on some filter. That filter is simply market cap and volume. That is also a quant model. It's a very simplified quant model. It doesn't have many variable or factors. As a fund, when we as quant investors go a bit deeper into quant investing, I think a lot more factors come into play. And each factor adds a layer to the model. Based on that, a list of stocks is generated and selections are made accordingly. So that ideally is quant investing.
I'm curious, is the final selection system generated picks, or is it ultimately the call of a human being like a fund manager? After weighting whatever the system has generated,
I think it's a combination of both. Before the system, who actually creates the system? It's humans who build it, but based on data. So, for example, today there are about 5,000 listed companies in India. From that, the investable universe itself is around 1,000 stocks. And around 2,000 stocks have decent volume and good quality promoters. Out of these 2,000 businesses, some need to be picked because as an investor, you have to build a portfolio of about 20, 30, 40 stocks. So the criteria are set by us, the fund managers or quant investors. But the criteria are made based on the last 20 or 30 years of data. So we look for patterns in the data. Okay, over the last 30 years, what kind of businesses did well? If you look at someone like Warren Buffett, so from his experience, he has chosen certain patterns. And what are those patterns? He says that he will not invest in tech businesses because tech is changing so fast that he cannot understand it. You understand? Like we're talking today, the tech NSE index is down 5% because people feel that stuff like Infosys can also be replaced, correct? So Warren Buffett, who follows pure fundamental traditional investing, as you were explaining at the start, he has followed that approach, but he has created rules in his mind. I will stick by this rule. He could also make a quant model by putting his rules down on paper, and then whatever the final result is after all these rules, this is the set of stocks that I am screening.
so a screening model is created, and based on that, the machine and AI will give you the results.
Absolutely. I think there's a slight difference between AI and quant, and people often get confused about it. Like yesterday, I was talking to someone, I had a 1-hour conversation explaining that I am into quant investing and how I do it. And in the end, he was like, oh, so you do AI. So there's a difference, and I think it's important for everyone to know this. In AI, what happens is that out there, the fund manager is replaced. There is no role for the fund manager anymore. You just provide the data, the AI model tells you that this performed well in the past and this is what you should do going forward. So as a human, you don't need to think. I don't know if this is going to become the future, but if AI can help us fasten the research process, then yes, we will use it. But in quant, there is still human intervention in making the model.
But AI is not yet so evolved that it can completely eliminate a fund manager.
I think we have to train those models. So for all AI models, for example, ChatGPT, the simplest form, or Gemini, when you use them today, you have to train that model on a day-to-day basis. I think everyone has to train it with their own thought process, and then actually you can see a lot more progress. For example, today, Ray Dalio is an investor, a macro investor, and he uses AI very deeply in his models. And he has been trying to clone his thought process into the model, so that if Ray Dalio does not exist, which could happen, so the investor should not suffer. All the investors in the fund should not suffer, because if that process exists, it can keep progressing. So I think AI will play a part in the investing process, not to say that the fund manager will be replaced or a human will be replaced, but I think it will add to the market.
It will make them immortals.
I think the goal is to make the process, like for example, if you go back to the 1990s when there was no data, you would get a new report at home and would have to read through an annual report. Now that process still works, but now you get all the data, so that process has become so fast today, we may be 2 or 3 steps ahead. So I think this technological advancement will happen and it will help in the research process.
Interesting. So for somebody who is hearing about Qode Advisors for the first time, so out of all the things you've mentioned, exactly which aspects do you deal with in fee investing? How do you bring that new age investing into the ecosystem?
So, at the Qode, the thought process was always not about the code because there are subjective elements. So there are 2 schools of thought. One is subjective stock picking, where a company looks good to us, we research it, we talk to the promoter, and we visit the factory. And then we make a subjective call that this company is good, its valuation is reasonable. Then there's the other approach, where everything is based on data-driven, systematic, objective decision-making. Decisions are not made based on gut feeling or instinct. So our thought process has always been that we want to leave human bias aside because I think that's what differentiates a good investor from a bad one. If you look at the track record of Warren Buffett, it's all about being objective. So at Qode, I won't use the term quant all the time, but we say that we want to be an objective stock picking advisor or PMS. The thought process is that quant becomes part of the framework because a quant is objective at the end of the day. So at Qode, what we do is look at data from the last 20 to 30 years. We try to find patterns in the data. For example, one of the stats that we found by looking at 20 to 30 years of data was that promoters from the age group of 40 to 60 are doing much better than promoters in any other age group. It could be a coincidence or there could be a logic behind it. So that's something that subjectively as a fund manager, we have to decide because there is no cause and effect relationship here. So we try to find such patterns. And then there are small things. There isn't a single factor that will contribute to the future returns. There are multiple factors and each factor will have its own weight. Nothing is ever 1 or 0. In investing, you'll never have 100% certainty when you pick any stock. Let me give you this example. Who is the largest holder in a stock? The promoter. Why does the promoter own the largest amount in the stock? Because who has the most conviction in their own business? The promoter. As an investor on the outside, I can only have so much information, but the promoter knows everything. So whoever has the most information will have the largest stake. And then the stake will keep reducing based on how much information and risk appetite you have. So the idea is that by using models, you want to get as much information as possible and make decisions accordingly. That is the approach we use within the Qode. And all of this is expressed through our PMS. So in PMS, we are running 4 different strategies. One is related to small caps. Another is an all-weather strategy where regardless of market environment, you are going to make money. In this, we look at allocation, whether to invest in gold today or in equities. So all these things are process driven, but at the top, what remains is that, you have to stay objective.
Okay, from a retail investor's standpoint, nowadays there are many mutual funds as well that are AI driven, AI backed or supported. So how are retail investors reacting to this? What is their acceptance or response like? Are they going for these kinds of products?
Some of the mutual funds are very good, and let me speak as an investor. I always say at the end, my objective and intention is that you want the investor to make money. There are some quant funds, and when I say quant fund, they are more like systematic funds. If you go to the NSE website, for example, the Nifty index data is given. This is just an example, not a recommendation. It's an index where, based on the last 1 to 2 years of data, it will pick the stocks with the least volatility. If you look at the portfolio, you'll see there will be stocks like Colgate, Britannia, Hindustan. There is no fund manager behind this. It's a mathematical calculation. Based on certain factors like how much a stock has gone up or down, the list of least volatile stocks is created. From that, we take the top 30 stocks, and those top 30 stocks get churned. So this is a quant model fund. If you see historically, all these indices have done very well, even better than the Nifty 50. Mutual funds, and it can be expressed through ETFs, and the expense ratio is also very low. I think in the US, passive investing is about 80 to 90% of investors are on the passive side. In India, it's still low, but people are moving towards that. So to answer your question, I think the acceptance will increase. People will realize that, this is actually making a lot of sense.
What kind of specific advice would you offer to investors about such opportunities, different types of investment vehicles, or various strategic avenues? How should they navigate this complex realm? Because it is quite common that not every individual retail investor fully understands quant or various technical terms so well, you never know. So what is the typical way that you would go about advising them in these situations?
So if you are a retail investor, I think investing is very simple. Ultimately, if the company delivers earnings, the stock will rise. If it doesn't, the stock will not move. Even if you use quant strategies, if you are smart and manage well, in the end, earnings growth is necessary. If earnings come, that's fine. If you are looking at a quant approach, you can break it down, for example. The indices that are there, so what you want to see, you don't have to do it yourself. How did I explain it? Now go and see which stocks are included in it. You will see Britannia, Hindustan, Unilever, and you will understand that even in consistent earnings growth, it will grow at around 10 to 12% because these are not high growth businesses. So you need to understand what the process is for these already mature businesses. And that process you can understand from the stocks that are being selected right now and in the past. Generally, the mistake investors make is, this is giving 20% returns, I want to invest in this. But that's a very top level approach. That may be one of the factors for the decision, but it's not the only factor nor the primary factor. You need to understand what kind of business you are going to focus on through this quant index.
Okay, Rishabh, according to the systems and processes you have and the software or technology you are using, what is your sense for the coming 4 to 5 years, or if we look till 2030, purely from a system standpoint, not from any human angle? And also, if you look at historical data, are there any interesting data points or trends that you are mapping for the next 5 years in terms of the economy and markets?
So the approach we take is a top-down approach. In a top-down approach, we look at what kind of environment we are in. Since 2024, for the world overall, it has been a very volatile environment. That means there are things happening in the world that we haven't seen before. For example, in your and my lifetime, we've always seen that the US has been a superpower. The dollar has always been on top. But as we know, we are seeing that there is a slow shift happening, and the fear is that the dollar will lose its dominance. The dollar might not be there. That's why Trump is doing all these things. See, the reason to believe people around you, because you are scared you will lose your seat. So the thing is that the environment is changing. So as an investor, the first thing you want to understand is whether this environment is something like this. It requires experience. It requires a lot of time and effort, but it's important to understand it, because when it happens, there will be a shift in the entire way the markets work. For the next 5 years, I think what's going to happen is that there's going to be a shift of power. When that shift of power happens, there will be volatility, which means that a lot of opportunities will come. Don't rush into your investing game today. You know, people say India growth story, as India will grow, India will succeed, and we will be one of the beneficiaries of this shift of power. But timing becomes a very important factor here. Anyone who rushed in 2024 thinking, I'll invest in small caps till 2030, but to see those double-digit returns, timing becomes important. The good thing is that I think the opportunities keep coming because volatility will continue. As we speak, just this week, due to trade agreements, the market is now up 3%. You find opportunities when the market is down 3 to 5% as well. So I think from now until 2030, the journey will be upward, but there will be volatility throughout this entire journey. And this is all data driven. What I'm saying is, have you seen this in the past? Listen, what do? We map the environment. We check whether the environment we have today has ever occurred in the past or not, right? Only in India, because in India, we only have 20 years of market data. Our markets are matured only from 2000s. But in US, Great Britain, all these places, they have seen these markets for hundreds of years. So whenever such things have happened in the past, a lot of opportunities have come up.
That is quite an interesting perspective. And again, looking at it from a broader systemic outlook and strategic point of view, are there any specific industries that are consistently generating and highlighting interesting data and insights from the Indian markets? Any industries in particular that are appearing particularly attractive to investors right now?
So, one of the places that you look at is capex, right? So when you're looking at government capital expenditure, there is actually a requirement that I think the energy space is very strong, because even looking into the future now, it's not about the result. It's about whether you want to be a part of a growth story where people are spending money because they'll see the benefits in 5 years. I think the energy space, specifically the transmission of energy and the setting up of transformer grids, that space is very exciting, because even now, if India needs to reach, say a second position across the world, we need to spend money in that space, because until electricity reaches there, factories won't run. So I think that space is very exciting, and data suggests that all the capital expenditure is happening there. So I think, someone had to do some research and think about that space.
That is a great point to start with. But if we are to talk about investing philosophy, usually the inception of any strong conviction, philosophy, or strategy, whatever you might choose to call it, comes from a deeply personal and significant inflection point in one's life. I am curious to know, what is the full story behind the philosophy or the specific investing approach that you adopt today? What exactly were the circumstances that led you to this specific path?
So I'll tell you, I started my career back in 2014 to 2015. So I did BCom from HR college in Bombay. And the good thing about doing something like BCom is like that you don't need to study for it.
That's wrong advice you are giving.
But the idea is that you get time. And the thing with what I believe in with the markets is that it's hard to learn much about the markets in college. There's a lot of groundwork that you have to do yourself. So if you are interested in becoming an investor, I think if you look at the life of any big investor, what did they really learn in college? Then knowing the basics of accounts, I think accounting is very important. So the thing that you get from a BCom is that your accounts become strong. So reading a balance sheet becomes much easier. But I believe you can do that from home as well. I don't think so. Education is
bad advice.
After moving out of college, even during college and after college, I was always interested in the equity market. I took up a role as a research analyst, did a lot of research analysis, made a lot of subjective investments, and I had lots of experiences where, you meet with management. And management is also charming because the company is obviously charming. He would throw out numbers and say things that would just convince you. It's very hard to decide subjectively whether this person will be successful or not successful. So that's where that process came in that made me objective. This process means you don't need to rely on how this person communicates, the way he speaks or his ideas. You can just look at his past data. So that's when I came across this. There is a book called The Little Book That Beats the Market. And an investor created a formula. In the US, it's called the magic formula. And he used two factors, return on capital employed of a business plus the valuation ratio. Now, by combining these two from top to bottom, the higher the capital and or the better the valuation, the better the company. And he did a test. If you just buy the top 30 businesses based on this ranking, what kind of performance do you get? And the results were superb. So we tested this for the Indian markets back in 2016. And it was showing a 25% CAGR for a 15 to 20 year period. We saw that finding something as simple as this is able to beat the index by large margins. That means there is some work to be done over here. And that's where we started this entire journey of quant investing. And over time, as an investor, you can keep building on different factors. Now, if you look at the Nifty as well, what has the Nifty done? 12% per annum, and there is no fund manager behind the Nifty. So with no thought process, no fundamental factor, just based on picking the stocks with higher volume and higher market cap, we will pick that you have done 12% per annum. So the thought process is, if we can add more factors, can we do better than the Nifty, right? And I think it's possible for anyone.
Yes.
That was the thought process behind getting into quant investing and systematizing things.
Most investors' journeys or success stories always have some data and experience behind them. But of course, there is also that personal self, personal life, which also shapes you. Who you are today, so in your journey, when you are not monitoring and tracking all the markets and numbers, what do you do? Is there any particular personal interest or a favorite hobby that keeps you grounded outside of the office? Or hobbies that also help you out in your professional life as well?
So two things. One is the influence that was on me, why I was inclined towards finance was my mother. Since I was very young, my mother was more inclined towards finance compared to my father. All the accounts were maintained by my mom. She was a housewife, but she always understood the compound interest. She taught me these concepts as a kid. Those concepts were not taught to me by my dad, even though my dad was the earning member. But my mom always understood that if you are able to compound money, and she was an investor from 1990, so she used to invest even while sitting at home, and she was always a reader too. That habit, I have picked that up from her even today. For the last 10 years, she's like 65 today, but she understands everything about quant finance. She learned how to code when she was 55, so the influence has been very strong on me that, okay, you want to be curious, you want to be a learner. I think apart from finance, what I ended up doing is I ended up playing the piano, always been inclined in terms of sports. I always was a part of a sports team. I used to play badminton professionally. Now, don't have as much time now, but these, I think they're just subtle things that have overall shaped me and my personality. But I think a large influence has been my mother. For me to get into this and being, interested, I think ever. Since you are young, you start developing a knack for something, and then as you get better, you enjoy it even more. So I think that's been the journey for me.
Amazing, and it's been a very inspiring journey, and you've shared some great insights with us, and you've really simplified concepts like quant for our viewers as well. Thank you so much, Nahar, for talking with us today.
Thanks, thank you.
And if today's conversation has inspired you to think beyond the headlines and to focus on discipline, structure, and long-term compounding, then we've done our job. That was today's episode of Market Pillars Uncovered. Don't forget to like, share, and subscribe for more such powerful conversations where we meet the leaders shaping India's financial future. Until next time, invest smart and stay informed.